What's good, everyone, and welcome back to the Financial Forward channel. We are on our free money good series #1, talking about income generating strategies dealing with dividends. Your income generating potential of the share market can offer a steady flow of income regardless of what the market is doing. A staple of any income generating portfolio are dividends, and in this portion we'll explain how to maximize their effect to enhance a portfolio's performance without increasing the downside risk. So we'll look at how to understand dividends, how to calculate a dividend yield, dividend cycles, and how to maximize dividend income. So grab your notebooks, buckle up, hands and feet inside the right at all times. Let's go, let's just money. So all investment strategies must take into account the investor's ability to produce income. Dividends from the stock market are a source of income, and a company's board of directors chooses the dividends amount. Okay. Now, although some dividends can be distributed as like stock shares, some dividends in other countries are distributed as cash payments twice a year. The example demonstrates some key concepts related to the dividend process. So the declaration date is the day the board of directors of a company makes the next dividend announcement public. Okay. Now, when a share trades, the value of the upcoming dividend is not taken into account in the price. This is known as the ex-dividend date. So prior to the dividend payment, the investor must own shares. Okay. Between the ex-dividend date and the date of declaration is the dividend trading period. Now, the record date serves as the deadline for determining which shareholders are entitled to a distribution. The payment is made to all shareholders on the dividend payment date. The requirement to receive a dividend on a share you own is simply to own the share prior to the day it trades ex-dividend. As an example, if a company is set to trade ex-dividend on August 20th, you must own shares in the company by the close of August 19th. Now, if you choose to sell your shares after the ex-dividend date, you are still eligible for the dividend if you choose to sell on that day. So what happens to the share price when a dividend is paid? Okay. In a mathematical sense, the shares should fall the exact amount of the dividend on the ex-dividend date, but the share price is, it's not a perfect mechanism. In a steady market with with low volatility, a share generally falls close to the amount of the dividend on the ex-dividend day. So if Telly is trading $4 the day before the ex-dividend date and is scheduled to pay a 15-cent dividend, you can basically expect that it will open at $3.85 on that day, right? In times of extreme volatility, it's not unusual to see a share price drop by 1.5 to 2 times the dividend amount. Okay. Shares typically recoup most of their dividends, if not all of them, within about 4 to 6 weeks if a market is not experiencing higher than usual volatility. Okay. Now, the dividend yield is determined by dividing the annual dividend by the stock's current share price. All right. The dividend yield, for instance, would be 10% for a share of a company that costs $10 and distributes $1 in dividends annually. Okay. The dividend yield may continue to rise, but this could be good or bad for the company, for the business, depending on the situation. Now, when it comes to dividend cycles, as an example, in the Australian market, companies pay their dividends at different times throughout the year, just like the American market. And there is no standard date that must be adhered to pay out dividends. Okay. Again, same thing in the U.S. market. There are generally 4 main dividend payment cycles that most companies fall into, and these are based around reporting seasons. Okay. I think it is a requirement for like all Australian companies to report financial results to the public a minimum of twice a year prior to the end of the balance sheet date. It may be the same for the US as well. Now, most companies have a balance sheet date in Australia for June 30th. In the US, it's December 31st. But there are some companies that operate under a calendar year schedule. The best place to locate the scheduled release of earnings reports are on the company's website, okay? Now, the first cycle of the year begins in February. Companies that trade ex-dividend during the third cycle, which runs through August and September, will pay their final dividend about 6 months later. So June 30th is the company's balance sheet date. At least in Australia. Again, in the US, it's December 31st. Now, the the second cycle lasts from the middle of April to the end of June. The companies that trade ex-dividend will distribute their final dividends during the fourth cycle of the year, which runs through the end of December. All right. Now, although businesses don't report on the same day every year, they typically do so, at the same time and, around the same cycle. So it just works for everybody. Now, due to the fact that they can report on a calendar year or a financial year schedule, there is no standard mandate for disclosures of financial results and the payment of dividends for business in the same industry. Okay. Now, when it comes to maximizing dividend income, the majority of retail investors hold their shares throughout the time between the dividend payments, okay? The long-term holders. And this exposes them to the shares fluctuations and the potential for a capital gain or capital loss. So due to the fact that not all companies report at the same time of the year, investors can maximize the value of their shares by rotating them in and out, of their portfolios, okay? A standard investment technique is to own shares and capture the interim and final dividends in a financial year. So an investor can capture multiple interim and final dividends from various companies by rotating the shares in their portfolio. After the dividends are paid, the investor can sell down the shares and use the proceeds to buy shares in a new dividend cycle. This tactic can basically be carried out while still collecting 2 to 4 dividends per year. Okay, so as you can see in the example, the shares are held for more than a month after the dividend is paid, giving a share the chance to increase in value and to return to its ex-dividend price or even higher. So if a share rises in value before the ex-dividend date, it's possible to buy it during the come dividend or the with dividend trading period, okay? With each purchase taking place roughly probably 2 weeks before the share goes ex-dividend, okay? So the use of this strategy has 2 benefits, okay? If the shares are rotated properly, an investor can receive 4 dividend payments with the same invested capital per year instead of sometimes 2 dividends, okay? This is how you can glitch the dividends, all right? This strategy basically gives an investor the chance to outperform the benchmark dividend yield even when the stock market is performing poorly, because dividend income is consistent and it doesn't fluctuate as much as the market can, okay? When switching between dividend periods, an investor can miss out on capital gains in a particular share. So due to the fact that this strategy does not necessitate a full-time investment in the markets, potential market downturns can be avoided. Okay, so this finishes off our first section in the free money glitch income strategies portion. Dividends are pretty straightforward, y'all. Next, we will learn about the second part of income generating strategies, income growth strategies. This is Bradley Barnett. I love y'all from yours truly, Financial Fourth.